lot of ink gets spilt over commodity super cycles, but at heart the economics is quite simple. It's about an imbalance between demand and supply that tends to build up. So sometimes you get surges in demand for commodities, but it takes a long time for supply to respond because it takes time to invest and build out supply capacity in commodities and in mining. So when demand is surging but supply is not responding, you get a big ramp up in prices, and then supply ultimately catches up and prices fall back. And that's what happened in the last commodity super cycle when China entered the global economy. It was integrated into the global economy in the 2000s. It's what happened in the one previous to that after the end of the Second World War. The demand impetus then was around European reconstruction. And then at the end of the 19th century, you had another one that was around US industrialization. So it's about these demand surges and supply not being able to keep up. And the narrative now is that the next impetus for the demand surge will come from greening the economy. Now, that sounds rather paradoxical, that measures to tackle climate change will actually fuel commodities demand, but actually those measures will suck in commodities because they require building infrastructure. That creates the demand for commodities, it pushes up prices, and so you get a super cycle. But as you say, we're a bit skeptical. Our commodities team, led by Caroline Bain's, done a lot of work looking at this. And our conclusion actually is that the drivers of commodity markets over not just the coming year, but actually the next 5 to 10 years, are going to have a lot more to do with what's happening on a rather mundane level in China than is a new super cycle related to climate action. Yeah, I mean, the short answer is that our commodities team work extremely closely with our China team. So we have a China team based in Europe and in Asia, and they work very closely with our commodities team. And there's two aspects of this, really. There's the tracking what's happening in a cyclical sense in China's economy. And often that's quite difficult to read the tea leaves there, but also picking up on the policy signals and the structural shifts in China's economy that will have implications for both China's economic growth rate, but also commodities demand over the longer term. Well, I think that there are two things there. What the CAP is doing is it's rather than having to rely on the official GDP data, which many have questioned, it's building an alternative measure of economic growth from the bottom up. And it's doing two things. What it's allowing us to do is keep track of the cycle, so how growth is moving from month to month, quarter to quarter, year to year, but also the structural trend as well. So how growth is playing out over many years. And on a month to month basis, a lot of the focus has been on the strength of the year-on-year growth number in Q1, reported in the official GDP data earlier this month in China. But actually, our China Activity Proxy shows that the quarter-on-quarter growth rate of the economy in the first quarter was a lot weaker. Actually, momentum in China is slowing. So our view is that in a cyclical sense, what's going to happen is that momentum is going to continue to ebb and fade over the course of this year. That will start to become more evident in the data that most people are tracking in China over the second half of this year. And so the narrative is going to start to shift in China's economy from one of leading the way to one of the recovery starting to fade, because actually China's recouped a lot of the lost output already that it had in the pandemic.